Hey, what's up? It's Max, and I would like to talk about a mortgage. So, if you guys know, I would like to take you on a path to financial independence through the real estate. And to begin that, you probably want to purchase your first rental property. And unless you have money up front to pay cash for your first deal, you are probably going to use a type of a loan that is being called mortgage. So you borrow the money and you use it in order to purchase your first property. You rent it out and you make money of it if your rental payments that are coming in are big enough to cover the mortgage, the expenses that you're gonna have on a property, and leave the profit to you. So the mortgage, what is it? Essentially, it's a financial lever. So imagine you have a boulder, a big stone that you cannot pick up. So you put a tiny stone next to it, you put some kind of beam, some kind of metal, long stick in between of them under the big boulder, and you use the lever to pick up the ball, to pick it up. So you're using only a portion of a strength, and the rest of it is provided through the lever. So with a mortgage, the amount of strength that they're putting on is a down payment. So you pay a portion of a price, and the rest of it is provided by the bank for the fee, for the interest that they're gonna get through the deal. So the way it looks like, if the house is being sold for $100,000, you're paying $10,000 as a down payment, borrowing $90,000, but through the life of a loan, you're gonna pay out about $150,000 or so. So you're paying extra $60,000 of fees because you use that money that you don't have yet. So what do you do to do that? In order to get a mortgage, you need to go to the bank or a credit union and talk to these people and ask if they really want to give you money. If you're a first-time home buyer, your down payment can be pretty much really low. If you're a regular buyer, if it's a second house, your down payment has to be 20% of a purchase price. So let's presume that we have a house for $100,000, and that makes the percentage pretty easy. The down payment has to be $20,000. But the first-time home buyer, their down payment can be as low as 3.5%. So for that house, it can be as low as $3,500. So how do you do that? How do you get there? Well, the way banks sees us is they need to know if they can afford to borrow money to us. So they need to know if we have a job, if we have a lawful source of income. So if you are a full-time / part-time worker, if you pay taxes, you need to bring them your tax return documentation, your W-2s, from your employee or employees. And they prefer, you don't really have to, by the rule of a thumb, they prefer to have last 2 years of your income. So you bring your last 2 years of W-2s. They look at those, so now they have an idea that you have a job, and you had a job for the last 2 years, and you were making so much money, so they now can start checking you out. They also need to know if they can trust you in a way, if you can handle a credit, if you can handle a loan. So they gonna look up your, people think that they go by credit scores. They don't really go by credit scores. And credit scores don't really change much, so you don't have to be all excited about it. My credit scores are 811 points. I never knew how much it was when I was purchasing my first house. I never knew how much it was when I was purchasing my second house. I did not even know, what was it? Like, how much did I have? What was it? 750, 720, 660? I don't know. I didn't know it was a thing. So don't sweat about it. Don't think about it. You can look it up to see the trend, if you're growing or falling, what was going on. I do have them now. I don't need it. I just like to show off. But yeah, don't sweat about credit score. Banks don't gonna judge you by credit score only. What they do want you to have, they want you to have at least 2 healthy credit lines. And by those, I mean any 2 credits. So a lot of people start to think, okay, car credits. So they start thinking, oh, okay, I need to buy a car, purchase a car through through a credit. Not even a lease, because lease is not buying. Lease is like borrowing for a meanwhile with an option to buy it later. So you don't have to purchase a car in order to buy a rental property. No way. I don't have a car. Never had a car. I'm walking home right now. And credit lines. It can be a car. Don't have to be a car. But 2 credit cards are enough. So they want you to have those 2 credit lines for as minimum as 2 years. So they want to see how you used to handle a credit. And by that I mean they need to see that you can handle a credit. So you don't have a late payments. So how do you do that? What's the way in? You get to the bank and you want to apply for a secured credit card. Smallest one they have. Those are usually like $300 worth. In order to get a secured credit card, you put your own $300 into their bank saving account, and you use that as a collateral for the credit card they're going to provide you. So something bad happens, bank already has the money to cover it. Then you use that credit card like a normal card. But what do you want to do with it? You don't want to use a lot of money. Some people think, oh, I have to use 60% or I have to use 20%. No, you need to use as low as possible. And by that I mean like buy a dozen eggs for $2 or whatever they are now, $2.50. That's it. Buy a toothpaste for $1.99 a month. That's it. Buy one thing once a month and pay it out next day. Don't wait till your statement comes in. Pay it out online or physically through the bank. Pay it out as soon as possible, next day or 2 days from the moment of a purchase. That's gonna show that you used 0.3% of your total possible balance on a card. You paid it out. It's gonna show them, it plays the game with them. It shows them that you can handle a credit while you were just buying cheap stuff. It doesn't show anything in real life, but to them it plays the number game, and banks see that you borrowed a small percentage of your allowed balance and pay it out in time. That's all you need. So you need 2 of those. 1 in the bank A and 2 from a bank B. I did not knew that when I came to US in 2012. So I went to the mortgage company, they sent me off. I went to the bank, they sent me off. But at least they explained me the rules. They told me you need to have 2 credit lines. And it's like, okay, let's go. I got 2 secured credit cards, one from so-and-so and one from the other place. I don't have affiliate ads on it, so it doesn't really matter what banks I went with. And I used those credit cards for 2 years. Well, to be honest, one of them became a full-fledged credit card because the place liked me. And the bank that I was banking with, after, I don't remember, let's say a year, they actually sent me the real card and said, okay, you can use those $300 of your collateral now as you wish. And you can have them back. You can take them as cash, whatever. Here's your real credit card. But you want to deal with that as the same way you deal with the secured credit card. Make small purchases. Pay them out in time. If you buy something big on a credit card, pay them out like the same day, next day, as soon as possible. Do not wait. Do not let that balance sit, and do not wait till statement. Even when a statement comes and says, okay, you need to pay $245, that doesn't mean the interest rate occurred yet. It shows that you are using almost all that you could use out of 300 from our example, and that's a red flag. You don't want to do that. So if you let the statement hit you, at least try to be as small as possible. But the promise for me is if you're gonna pay it on the next day, you're gonna be in a green light forever. There's gonna be no stops for you. You're gonna be going. So if you're gonna come to the bank, give them 2 credit line history from the prior 2 years and 2 W-2s, you need to have as low as 3.5% of a down payment. So if the house that you're looking to buy is like $100,000 house, these behind me are probably like 120, 130. So you want to purchase that? Well, you need $4,500 as a down payment, which is a lot. Might be a lot for somebody, but not at $30,000 from Dave Ramsey's examples or the other big wigs examples when they are talking about purchasing rental property somewhere in Texas or whatever. Well, I do live in Indiana, in the small city of Muncie, and yeah, housing here is great. Prices are great. I bought my first house in Muncie for $13,000, and yeah, it was great. Good times. So, you go to the bank. You do all what I just told about. At that moment, they pre-qualify you for a certain amount, and that amount is 45% of your income. And by that, I mean, if you are making $2,000, they can borrow you only amount as big that the payment of that amount monthly is going to be less than 45% of your income. Again, you are making $2,000, so they're going to allow your mortgage with a monthly payment less than $900 monthly. So you're making $2,000, you're not going to be paying more than $900 in mortgage. You don't want to go all the way to the maximum, but that is your maximum. That is your ceiling. Cannot go over it. So they pre-qualify you for an amount, a certain amount. So if you make $2,000 with a payment of $900, they're probably going to be able to borrow you about $90,000. $90,000 for 30 years. Always try to go fixed interest rate, no matter what bankers tell you. They're going to try to sell you something that they want to sell you. You want to go fixed, because if interest rate going to go lower at some point, you always can refinance. They hate to refinance, but obviously because they're going to lose money. So you have an option to refinance if the interest rates go up. Down. Well, you always have an option to refinance, but you don't want to refinance if the interest rate goes up. So you go 30 years fixed, and you have your pre-qualification. Then you have your agent. You don't have an agent? Go get one. Go on a Zillow. Look up the houses. Go to Zillow.com or Realtor.com. Look up the houses. Look at them. Look at the prices. Don't fall in love with the houses. Don't think like, oh, this looks so cute. No. Those are rental properties. Those are going to be numbers in your Excel spreadsheet. Don't fall in love with them. Look something that is 90 or cheaper. And you'll be like, oh, that's a crappy house. Well, guess what? You're not going to live with it. Somebody's going to rent it from you. And yeah, it might be a person who works in McDonald's and make $12 per hour. They need to live somewhere. They're going to live in a house that you consider ugly, but that's going to be their home sweet home. Don't judge them. So you look for the house and you find the house and it's $60,000. So even through the Zillow or Realtor, you can ask the selling agent to be your agent. You don't really want to do that. You kind of need your own agent. So ask friends. Everybody have a family member or a friend who is a realtor agent. These guys are gonna help you, but they're kind of your friends. They are your allies. Let's go that way. They are not your friends. They're gonna live off commission. So the way it works, they want houses to be sold for as much money as possible because they will receive a commission. You want a price to be dropped, and they will be like, They will make up, sometimes fake, sometimes not, but they will make up ways for you to try to think that, well, you cannot drop the price. You can't drop the price, always. So you do an offer for the house through your agent. You tell your agent, okay, give them the offer. So your agent is going to talk to their agent. You're probably not going to see the owner. You might see them in a title company when the deal is closed. You might not. Haven't seen half of my, sorry for the wind. Haven't seen more than half of the people from whom I was buying my houses. And yeah, you do the offer After that, banks make you buy the insurance, do the inspection, after which you can always drop the price even more. And then you, instead of pre-qualification, you are in a contract with the seller. So seller cannot try to sell the house to somewhere else. They stuck with you for a month, and you go through your bank. Now you apply for real. They run the numbers and double check everything. And the previous thing was pre-qualification. Now they actually quote you and they tell you, oh, okay, it's 80, not 90. And you're like, okay, good times, because the house that I'm buying was 60 and I asked for a lower price. I'm actually gonna buy it for $50,000. So you close the deal, bank pays, the seller creates a loan for you. You pay a down payment to the bank, it disappears, it goes to the principal of the loan. And you go from there. Your first month is free. It's the way mortgage works. So you purchase a house in August, you don't have to pay your mortgage in September. The first payment is October. It's just the way mortgage works. Don't think a lot about it. It's like a freebie. And bam, you got your house. That's it. It's not a rocket science. Yeah, you go to title company and sign 40 pages long contract with all the, small font and everything. Fun times. First time you're probably going to be sweating and wearing a suit and everything, and the 7th time you're going to do it, you're going to be bored. And then you get the title, you officially are the owner of the house, and you can go and rock in it. Then you do what? You start look for renters. But we're going to talk more about it in the next video. So if you like this one, hit the like button. Want to hear more about it? Hit the subscribe button. And I'll see you next time. Bye.